Hey there, everyone, and welcome to this latest episode of the Market Misbehavior podcast. I'm your host, Dave Keller. Pleasure, as always, to bring some fun conversations with leading market practitioners, strategists, analysts, money managers, and in today's episode, an educator. Today, we sat down with Russell Rhoads. He's the author of the VIX Trader's Handbook, also the author of a number of other books on investing and some other topics. He's currently a professor at Indiana University's Kelley School of Business, although he has some great street experience, including some fantastic experience on the floors of the Chicago Board Options Exchange, the SIBO, where he at one point led the educational effort to educate traders on how to actually trade the VIX. I use the VIX all the time as one of my main sentiment indicators. What a fantastic opportunity to sit down with someone like Russell virtually and ask all the questions I could come up with in terms of the VIX. We covered all sorts of things in terms of the VIX futures, VIX ETNs, different options related products, how they all relate to the underlying data of the VIX. We talked about zero DTE options and how they may have impacted, as you know, those structural changes and what that might mean for the VIX. We talked about the VIX into 2024 at one point in August, spiking to one of its highest levels on record. He actually had some really good insights on how to make sense of that particular move, and also talked a lot about the difference between key levels on the VIX and also the trend in the VIX. And he had a really important factor to be looking for going into 2025 in terms of the relationship between the S&P 500 and the VIX. We talked about the put-call ratio. We talked about potential manipulation in the VIX and all sorts of other topics as well. At the end, super sneak preview because he's a prolific author, but he has his latest book that he's working on for early next year, talking about Warren Buffett's trading patterns and sort of digging into his cash positions, what stocks he's buying and selling. He has some initial takeaways to share with us at the end of the discussion, which I think you'll really enjoy. So please, I hope you appreciate and enjoy this conversation with Russell Rhoads. All right, so everyone, welcome to the Market Misbehavior podcast. I'm super excited today to sit down virtually with Russell Rhoads. Russell, welcome to the podcast. Thanks so much for coming on today.
Absolutely thrilled to be here. I haven't told you this yet, but I do. I live in Chicago and teach in Indiana, so I'm in the car about 7 hours a week, and you're on my playlist.
Nice.
So
There we go. There we go. I appreciate it. Hopefully we can get to some discussion about the Midwest. I grew up in Ohio, so always love sort of reconnecting either directly or virtually with that area of the country for sure. You wrote a book that
I see the big red O behind you.
It is a subtle, and it's a sad time for some of us, but we're recovering. We're keeping happy despite football performance in recent weeks, Russell. Your book, which I've read, and I would highly recommend, the VIX Trader's Handbook, among others, I think was really well done. And I see it in your background as well. Talk to me. I mean, it started at a high level here. I mean, I feel like a lot of investors have sort of a general sense of what volatility is, and they kind of get the VIX, but they probably really don't. And I know just from flipping through your book, it filled in a lot of those blanks in sort of my own understanding. How, at a high level, how should investors think about volatility, particularly those that are looking at equities and other asset classes?
The way that they should be looking at VIX is it is a forward-looking indicator, and goodness gracious, we have definitely seen that in 2024 with the way that it behaved in front of, and then right now it's in the 13s after the election. So you've got to, and the common thought, and when I ran education at SIBO, I would often get to speak to reporters about this very topic. And you often see this belief that VIX is supposed to automatically move in the opposite direction of the S&P 500, which is not necessarily the case, especially when we've got some known unknowns coming up, like the election, or even the employment number later this week. You'll see a little bit of a bump in VIX. VIX holds up a little bit better the first week of every month than it does later in the month. And part of that is because the first Friday of every month we get an employment number. And you do see a bit more of a volatility. I don't want to say crush because it just comes down a bit, but I have noticed that the employment Friday behavior is a bit different. And again, that's because of the anticipatory nature of VIX. It's an indication of how much option traders think the S&P 500 is going to move around over the next 30 days.
And the VIX in 2024 has been obviously pretty interesting. I'm going to bring up a chart here just so we can look at it together.
Sure.
The VIX in August, when we had that big, sort of sudden sell off, the VIX spiked to one of its highest levels in record, right?
Mhm.
Kind of popping up into the 60s on an intraday basis. You talk about sort of that forward looking nature to the VIX. How, when you're looking at the chart of VIX and when you're thinking of volatility in a year like 2024, is there a framework that we should use to sort of understand the volatility conditions? I think a lot of people talk about we're in a high volatility or low volatility environment. What does that actually mean in terms of the data of the VIX and how that's evolved over time?
So there's a whole I could do an hour on what you just asked. First off, I think that move in August deserves an asterisk, and
Yeah,
the reason is it occurred before, and I'm in Chicago. It occurred before 8:30 Chicago time. It
yeah.
occurred when S&P 500 index options were open. It also occurred around a time where a lot of the market makers are resetting their bids and offers. So, and when that
Mm,
happens, it automatically gives a boost to VIX because VIX is calculated using the midpoint of the bid-ask spread. So if you're widening your markets out, you can only go so low, but you can widen out much higher. So I do think there was some of folks getting out of the way, and if the same sort of news or the same sort of move in the S&P 500 futures had occurred a couple hours later when the market was open, that maybe
mm,
we would have seen mid 30s to maybe the mid 30 range. One of the things that you want to do when we get these extreme moves in VIX, and how what I always tell traders, even if you never have any intent whatsoever on trading VIX futures, you want to look at the futures contract relative to the index.
mm.
That's where people are actually putting money to work. And one of the things that everybody needs to know about VIX is there is not a fair value relationship between spot VIX and the futures contracts. It's just I don't work at SIBO anymore, so I don't have compliance getting on me about this one. But it really is impossible to replicate spot VIX in a portfolio. If you
Right.
could do that, I would buy VIX at 13 and a quarter, where it is right now, and sell maybe the January future, which I think is what I had it up, and then of course I put it down. But the January future was at 16. If I could buy the spot at 13 and a quarter and short the future at 16, I make quite a nice penny there. So you
Yeah.
want to pay very close attention to the front. I always pay attention to the front two months VIX futures,
Mhm.
especially when VIX is doing, outlier moves like that. And it gives you a better feel for what volatility traders actually think. And I believe the front month VIX future, when we got that move up to the 60s, I think it did go into maybe the low 30s, if I
Yeah,
remember
so
right.
yeah, and you address that in your book, which again, you did such a great job of sort of listing out some of these structural nuances with it. I mean, a lot of people think of the VIX and the VIX futures like the S&P and the S&P futures, but different because the S&P you have like underlying. You could create a basket of the S&P if you really wanted to. You really
Yeah.
can't do that with something like volatility. It's a really good point about thinking about the futures. So the VIX futures have obviously become, have been, unleashed on humanity and have grown in trading activity. Do you think the activity in VIX futures and other related instruments like ETNs has impacted the value of the VIX as a market indicator, or as its traditional role of understanding volatility, or is that not really an issue?
That the derivatives that are based on VIX have had any impact on the actual VIX level. And
Yeah.
again, that's just because if and I'm going to get into zero DTE because you can't talk about anything without DTE. But with respect to VIX, the if there was a fair value relationship between the two, and I came in to sell the VIX future and buy spot VIX, that's going to push spot VIX up.
Mm,
But again, because we can't trade the spot, that does create some issues. The area that, and I don't think it's having quite the influence that a lot of other people think, but the very short dated index options that are available in, if I want to hedge, uh, the next three economic numbers, and those are the only hedges I want to have in December, I can pick those days as we go along. That has probably had a little bit of a dampening impact on
mm.
spot VIX, but I do really, I know from having the ability to still go in and talk to traders on the floor of the SIBO that the market makers for the short dated index options are treating it like two separate markets.
Mm,
So I'm not really sure if the short dated index options have had quite the impact that we would expect. You always had Friday expirations as well to hedge with a little bit shorter time frame. I
mm,
do know that SIBO switching from standard monthly options to weekly options. Now VIX is calculated with the Friday options that expire just before 30 days and just after.
right.
When the election was coming up and the first Friday after the election started to fall out of the VIX calculation, you totally saw the VIX spot VIX come under pressure just
Yeah.
because the options that had higher volatility had fallen out of that calculation. At the same time,
Mm.
as that VIX as it came under pressure, you couldn't see the same impact on the futures. So the futures traders are aware of the anomalies that show up in VIX like that and adjust the futures accordingly. And I really don't think the short dated index options have had that much of an impact on, or an impact at all on spot VIX.
Yeah, I'm glad you went there, Russell, because I feel like a lot of certainly retail investors are nervous, I would say, uncertain, because the ripple effects of the zero DTE options are sort of an uncharted territory, pun intended, right? So sort of figuring out how it impacts something like the VIX would be interesting. Now, this sort of change in the structure of the options market. I mean, the VIX has changed its own structure at times, right? And
Mhm.
there's the old VIX, right, VXO, which goes back a lot further, sort of and those were on S&P 100 options originally, right?
They were initially on S&P 100 options, and and which is great because we have a pseudo VIX going back to the crash of '87,
Right.
and one of those things where when I was at SIBO, I wanted people to trade VIX, trade it well, do well with it, have it achieve their goals, and not get run over. And shorting volatility is a way that you can shorting volatility without some sort of protection is a way that you can definitely get run over. And when I tried to make that point, I would always show that old VXO chart where it
Mm.
spikes up to 150 in October of 1987.
When you think about some of those volatility events, again, going in some of the deeper history, and I mean, I know now with the market having such an incredible 2024, I mean, the S&P is having, its best years on record. I mean, a lot of people are concerned about the next big, event that's going to happen. What can we
Yeah.
learn from some of those historical events with spikes in volatility and rotations in risk assets? What would you be looking for now with something like the VIX?
What I'm going to be looking for now is with respect to VIX, and I'm really in a wait and see attitude. I've pretty much taken pretty much all the speculative type positions that I trade. I've taken them down. I'm going to be away for 2 weeks in the second half of December, so I don't want to worry about that. But when I get back, I would. I'm not particularly bullish on the stock market, mainly on valuation. In fact,
Mm,
I wrote the stock market outlook for the Kelly School. We do that each year. Uh, we write it with 2 months left in the year, so there's a whole lot of speculation. In fact, the first draft was before the election, if you can
wow.
imagine that. I had to give a talk about on October 30th was my first speech about what I thought the market would do, and all I said was I thought they would both be equally bad for inflation. That I'm concerned about inflation. If
Yeah.
you remember when we got that Volmageddon back in 2018, leading up to that, VIX and the S&P 500 for about 6 weeks trended together.
Yeah.
And when those sorts of things would happen, the comms people at SIBO would start fielding calls from reporters. What's wrong with VIX? Is VIX broken? Blah blah. And I'd get to come in and talk to them and say, no, it's that option traders are concerned about some sort of a sell-off. We're seeing VIX climb with increased put volume versus call volume. I if there's true concern about the overall stock market as we have a transition of power here. And I see that sort of pattern emerging in late December and early January. I'm really going to be preparing for some sort of dramatic sell-off. Uh, Typically, the sell-offs don't occur because of valuation, and we are at the highest levels of valuation on a whole ton of metrics with the S&P
Yeah.
500. But what you need is you need some sort of catalyst, and it's very difficult to guess that catalyst. I don't think anybody in 2018 had Russia's going to stop making coupon payments on their debt to create Volmageddon.
Yeah.
You know, some people felt like the ETPs might exacerbate it, and they were dead on with that. But nobody really anticipated that macro event. Heck, this morning, uh, South Korea declared martial law.
Yeah.
Did you have that one on your bingo card for 2024? I mean, I'm hoping there's a good reason for that, and it's just not politically motivated. But the other side of that is if there's a good reason for it, there may be some real issues going on over there. And that's a pretty major financial market. So, it's going to be some sort of strange catalyst from out of nowhere. And because the valuation of the equity market is so high, I feel like we could see a really significant sell off, probably. I mean, and I'm really thinking in the first half of 2025.
Right.
But
Right.
I'll watch the VIX S&P 500 relationship, because when they trend together, that's often an indication that option traders are worried about the direction of the S&P 500. Managers are hedging themselves a bit more than they normally do, and that's what that's where I am on that one. And as you mentioned, one of the things I really like about the VIX book that you showed is I go through how VIX behaved leading up to, during, and after a lot of volatility events. I almost feel like I've got to add a few things and maybe throw them out there on my Substack in the same format, because I do
Yeah.
think there's an awful lot to be learned from what it acted like in those outlier events.
For sure, and I really, that third section of the book was all like a history lesson, going through some of the major sell-offs going back to 1987, and what things looked like. And for me, I mean, the reason why I use charts as a primary investing tool is because of the history lesson they provide. Right, you can look and
Yeah,
see what
yeah.
happened, what moved, and all of that. You had mentioned, and just to clarify, I think what you were saying was, there's that traditional inverse relationship that is pretty well documented between the S&P and the VIX. But what you were suggesting is, if we see stocks continue to go higher, but on elevated volatility, that's one of those, the relationship has kind of changed and it's probably going to switch back, meaning the market going higher, but with elevated volatilities, usually a bit of a warning sign. Is that a fair review?
Exactly.
Okay.
Because VIX, although VIX, I described it in the purely academic sense, which
Yeah.
is the option market's prediction as to how much volatility we're going to get for the S&P 500 over the next 30 days. VIX is driven by the put action. We
Mm,
trade about 1.7 puts for every call, and the primary use of the S&P 500 index option market, when you go out, a few weeks to even months and even years with leaps, is managing risk around an equity portfolio. So when you see
mm,
VIX elevated or working its way up, even as the stock market's working its way up, that means that managers are buying stocks, pushing the stock market higher, but they're also putting on hedges as they do so.
yeah, you and that relationship. Can you talk a little bit more about the relationship between the VIX and the put call ratio? And I'll be
Sure.
honest with you, until I read your book, I often thought of those as kind of different indicators, right? VIX looking at volatility, put call ratio looking at positioning, but you kind of
Mhm.
married the two in a meaningful way. How do those relate as you're assessing market conditions?
Well, I'm gonna curveball you here. So there's a VIX on the Russell 2000,
Yeah, right, right.
and Russell 2000 index options behave differently than S&P 500 options. And what we see sometimes is small caps start taking off to the upside, and a FOMO trade results in folks buying out of the money calls on the Russell
Mm,
2000. And so when you and Rick Rosenthal, who's kind of like the Russell 2000 person over at SIBO, pointed this out to me. So I definitely want to give him credit on this. But there are a couple of times that small caps were playing catch up. And when that was occurring, we were seeing more calls trade than puts trade on the Russell
mm,
2000, and RVX, which is the Russell 2000 VIX. It was
right.
moving up, and it was moving up based on call activity. I don't ever remember seeing that with the S&P 500.
Yeah, yeah.
And with the S&P 500, the what really drives the implied vol is the put side of the equation. And what I mean by the put side of it's just folks that are a bit concerned about the overall market. They're gonna, probably buy some out of money puts. Out of money puts, they end up the action in the out of money puts really does drive VIX. So even though VIX is based on the calls and the puts, it's being driven by the puts. The Russell 2000 one is kind of an outlier. It can be driven by the calls or the puts, which is really interesting. You'll see the Russell 2000 up 4 or 5% in a week, and you'll see the RVX move up as well. And a
Yeah,
lot of that is
right.
being driven by call action.
So good warning not to attribute the traditional relationship with things like the S&P and its volatility, maybe with some other assets. And there's a VIX on the Nasdaq as well, right? The VXN, which is out there. What can we
VXN
talk?
doesn't experience the same thing. VXN
Okay.
behaves more like VIX than RBX.
When you're looking at just the back to the S&P's sort of traditional measure, the VIX, I have horizontal lines. This is my chart that I refer to often in my own work and in videos that I produce, looking at the VIX in the top half and the S&P in the bottom half. And I talk about volatility regimes, and I was thrilled to see you described in a very similar way, which is, just the range in the VIX. I think a lot of people kind of hard code a level, like the VIX above 20 is bad, the VIX below 20 is good. Do you think that there are hard and fast levels that have meaning that we should be watching, or is it more about where the VIX is now relative to where it's been more recently? How do you kind of think about the VIX level and sort of drawing conclusions from that?
Definitely the level relative to where it's been recently. I
Yeah.
don't know what moving average you have on there, but I've often used a 20-day moving average
Okay.
to differentiate between the two. I like the 16 level.
Okay.
And the reason I like the six, there's no, I haven't back tested it. There's no huge quantitative reason behind this, but the reason I like the 16 level is, have you ever heard of the rule of 16?
No. What is that?
Okay, so market makers back in the day when they were working with pieces of paper and they were trying to figure out what the implied, what the implied volatility should be relative to what they're seeing in daily moves. If you take 30-day implied volatility and you divide it by 16,
Okay.
you get about what the market is predicting for a 1-day move. So
Right.
16 on VIX indicates expectation of daily moves are up or down 1%. And
Ah.
that really, it's not like when VIX is under the 20-day moving average, be bullish or bear. There's no back testing to justify that number. That's
Right.
just a floor trader figure that is kind of stuck in my mind.
I love that. How when you had experience at the SIBO, I mean, obviously educating, I think many traders on how to think about some of these concepts. The structure of the floor, the structure of the exchanges in Chicago has evolved so much just since I started getting involved in the markets in 2000. Do you think the change in the way that these things are trading, just in terms of the structure of the floor and all of that, has affected volatility or how we interpret volatility? Or do you think how we're thinking of it now should be similar to how we would have thought about it in previous bull and bear cycles?
The difference is the number of liquidity providers that are out there. We've seen consolidation among the number of liquidity providers, and there are probably 5 or 6 main firms in the S&P 500 pit now. When I was at SIBO about a decade ago, I feel like there were 11 or 12.
Right.
But those firms, they've all consolidated, and I don't think it's impacted the liquidity at all. But if we've got some sort of volatility event going on and you have fewer firms posting quotes, that could attribute to higher VIX than would have occurred with more market makers in the market. And
Okay.
then another big structural change, and it's not the exchange, but it's on the basically structured products using index options have proliferated. And I've tracked the 1 through 5 day S&P 500 at the money straddles. Just price the straddle today's Tuesday, price the straddle on the close today using the options that close tomorrow and see how well that straddle prices the move. In 2023, more often than not, and most months, the short dated at the money straddles were overpricing the move, which is what you would expect.
Right.
That is not the case in 2024 at all. And I believe that, there are ETFs that every day come into the short dated index option market and they're mostly selling. I think that has suppressed the short term volatility and flipped what worked well in 2023 on its head to 2024. I keep updating the monthly numbers, and that's going to be my big welcome to 2025. Look at this thing.
Yeah.
Just a big difference between the 2 years.
It's very interesting. I have one more question, Russell, about the VIX, and then we have one more topic I want to get to. I work with a lot with individual investors, with retail investors. I know you have as well. I often get questions about manipulation of the VIX, right? People and manipulation of all sorts, right? Are market makers doing things to make life harder for me as an individual trader? Do you see that as an issue in the VIX, and why or why not?
No, I really don't. I don't think that's an issue in the VIX at all.
Yeah.
There are plenty of liquidity providers in there, and the markets are typically a nickel wide, which is the minimum tick for that. The one area that you'll hear criticism is the VIX settlement process, which is extremely transparent. And I know SIBO does things to try to provide to get as much liquidity as possible on the open on Wednesdays in the SPX market to try and get a decent settlement value. So as a personal experiment, after I had left SIBO, I tried to figure out what would I do if I wanted to manipulate VIX settlement. And I just looked at the options that fed it. They tell you which SPX options are going to feed into VIX settlement. And what I did was I took a look at if I went in and I wanted to make it higher. And I put buy orders in for all of those options, but then I had to turn around and sell them because the VIX settlement is based on actual trades. You can't just put a bid in there and push the bid ask spread higher. It's actually based on an actual trade. And if I put a bunch of buy orders in on the open, I could try to manipulate the VIX settlement higher, but the trading costs were well into mid seven figures.
Wow.
So it would cost $4 or $5 million trading to manipulate the VIX settlement. So you need to be doing something that's gonna change that settlement that much in your favor.
Yeah.
Also, VIX options stop trading the night before settlement. So if you're trying to do something where you're going to manipulate the VIX settlement on Wednesday morning, you are taking some overnight risk as well. And I can't even quantify that for you. So,
Great.
I think if you're going to try to manipulate it, you want to manipulate it to the upside because there's not going to be a huge downside surprise.
Right.
And really the way to go about doing it is buy a whole ton, like 150 different SPX options on the open, and then you have to turn around and sell them. And the bid ask spread on all those things was just ridiculous.
Yeah. Okay. Highly unlikely.
I tried it. It can be done, but you can't make money off of it. How's that?
Now, we've talked about your book, The VIX Trader's Handbook, and again, I really enjoyed it. I'd encourage people to check it out. You have another book actually coming out in the new year, hopefully in the spring, talking about Warren Buffett. We just have a minute or two at the end here.
Sure.
Talk to me a little bit about what sort of initial takeaways you've gotten from this deep dive into Buffett's holdings over time.
Well, and what the book, and this thing has taken me so much longer than I thought it would. The book idea, I've been at Indiana for 4 years.
Yeah.
I was at Loyola Chicago before that. The book idea came from a student at Loyola. So that tells you how long it's taken me to get around to this thing. And the question was, we talk about how you value a company, blah, 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 when we're teaching undergrads in investments. And I had somebody go, well, how does Warren Buffett decide to sell a stock? Nobody's ever written a book on that. So the book is called When Genius Sells. And believe it or not, since I hate when people do trick questions. He's gotten out of 170 investments in the last 20 years. It's not like, this buy and hold thing. When you start digging into the 13F filings and everything, I've got a lot of instances of him complete, and those are complete sells. That's not reducing his position, taking up his position. Now, in the news lately, was how much cash on hand Buffett has now. And what I did was I took equity as a percentage of cash plus equities, and
Okay.
cash also includes short-term commercial paper in here.
Sure.
And they're at the lowest level they've been since 2000. That other bottom tick is around 2004 or so. I do want you to
Wow.
notice, go ahead and highlight that uptrend there, that they did nothing but add, they went from 50% to 75% by mid 2007.
Wow.
So his cash levels probably are not a good predictor of what happens within the market, that of a sell-off in the market, et cetera.
Yeah.
I did notice, and I didn't, I'm still working on the chart on this one, but I did notice that when they reduce their exposure, but they're not selling out of big stocks,
Hmm.
they seem to be taking down their positions in financials and then taking them back up. Financials have always been somewhere between 30 and 45% of their holdings until this past year or
Right.
past couple of years. And the only reason that it's a much lower level is because Apple ended up being over half their holding for a while.
Sure.
I'm sure everybody that owns Berkshire loves that they made a ton of money off of Apple. I think he got an 8-bagger off of what he's gotten out of so far.
Right.
But it's really screwed up my analysis of because when they're not most heavily weighted in financials, they're most heavily weighted in consumer staples. They just flip back and forth for like the first 15 years.
Interesting.
Yeah, so that and that's a market call. I don't
Yeah.
care what anybody says. When even in the academic world, if you're worried about the stock market, you're overweighted consumer staples and you underweight financials. One of the things you underweight. This chart requires some explanation.
Sure.
So the blue line is the total return. I'll go all the way to the far left. That was the performance for the S&P 500 in 1996. That little burgundy line or purple or whatever that one is, that was their change in cash during 1995. So they reduced their cash level in front of a year that the market went up.
Right.
You can see when the line is above, and I might have to redo how I explain this in the book because it's just it's too complex for something that's so simple.
Yeah.
In 97, they increased their cash levels by 20%, or in 96, and then the stock market was up. So basically, the chart shows you that using Buffett raising cash as an indicator to trade the stock market doesn't work. In fact, the correlation between changes in cash and the following year's S&P 500 performance was like minus 0.03, basically no relationship whatsoever. So,
Wow.
he says when he's raising cash, it's because he doesn't see good investments. And he says it's not really a market call. I think there are some market calls in there with respect to their weightings, but not necessarily with their cash levels.
This is super exciting. I can't wait to see, just given what you did at the end of your book on the VIX, looking at that history lesson. I'm excited to see what sort of nuggets you can uncover when you dig a little further into that data. Russell, this has been such a pleasure. I can't
I
thank you enough for
appreciate it.
coming on the show. I enjoyed the VIX is something I refer to all the time, and the opportunity to ask someone like you some great questions about how we should think about it. I think I know our audience is really hopefully enjoyed. Where can people follow you or learn more about your work and what you're doing these days?
Pretty much anything that I do. Like, I'm terrible about this. There we go. There it is. There's my Twitter. It's just my full name, not RHODES. That's a news anchor down in Tampa that got a DUI once. It's RHOADS. So there you go.
Perfect. We'll include links to that and also to your book, The VIX Trader's Handbook. I hope we can have you back once the new book comes out next year. But wish you very well between now and then. All right.
All right. Thanks a lot. I really appreciate the opportunity. Thanks.
What a great opportunity to sit down with a noted expert like Russell Rhoads, someone who literally wrote the book on the VIX and how to think about volatility. Questions have been lingering in the back of my mind, like, how do you answer someone who asks about manipulation in the VIX? What key levels are most important and why? What should we be looking for thinking about the VIX into 2025? And I think his comment, if you caught it, about looking at the directional move in the VIX, thinking about the VIX and the S&P maybe moving together. So if we see a rally in stocks combined with an increase in volatility, that could be a big warning sign. And as we think about potential warning signs to look for in early 2025, that has now bubbled toward the top of my list of things to look for. I thought his comments at the end were really fun, thinking about Buffett's trading patterns. We'll look forward to having Russell back, hopefully in the new year, once that book is out. But for now, I hope you enjoyed that discussion with Russell Rhoads. As a reminder, link below to get to Russell's work via social media. Also a link to check out his book, The VIX Trader's Handbook. I've read it and I would strongly recommend it. It was an excellent read. I hope you enjoyed this podcast series. Always looking for ideas for new people and new authors to talk with. So if you have anyone that comes to mind, drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts.